In the previous sessions, we explored how ESG contributes to building brand reputation, enhancing operational efficiency, fostering innovation, improving employee engagement, and strengthening risk management. While these benefits are significant, the ultimate objective of any business is to generate profits. To remain sustainable in the long run, ESG practices must also positively impact the financial performance of the company. In this section, we will dwell into the ways ESG contributes to a company's financial performance and examine key insights from research studies that highlights its economic value. There are four broad ways in which ESG practices contribute to better profitability. Strong ESG reputation attracts customers who prioritize sustainability and ethical business practices. We saw in the examples of Patagonia, Tesla, IKEA, etc. ESG driven innovation allows businesses to explore new market opportunities such as renewable energy, electric vehicles, or biodegradable packagings. Company with an ESG edge can often charge premium prices for their products due to their perceived higher value. Product innovation, enhanced brand reputation, and strengthened customer loyalty collectively drive higher revenues, accelerated growth, and ability to command premium pricing. Implementing sustainable practices can lead to energy efficient processes, reduced resource consumption, lower operational cost, and improved efficiency. For instance, companies that invest in renewable energy reduce energy expenses over time. As we saw in the previous sessions, a strong commitment to ESG can boost employee morale, attract top talent, and reduce turnover costs, further adding to the bottom line of the organization. ESG practices enhance supply chain efficiency by optimizing logistics and encouraging the use of sustainable materials, leading to leaner operations and lower operational costs. ESG practices helps companies identify and mitigate potential risks such as climate change, supply chain disruptions, and reputational damage. Strong ESG practices can help company comply with evolving environmental and social regulation, avoiding costly fines and penalties. By mitigating physical risk like extreme weather events and natural disaster, companies can protect their assets and operations. Companies with strong ESG ratings are able to assess capital at lower cost as they are perceived as lower risk investments. This reduces the finance cost for the company. ESG practices also open doors to green financing options such as green bonds and sustainable loans. This slide illustrates the overall impact of ESG practices on the final profit and loss statement. As demonstrated, ESG initiatives positively influence revenue growth while simultaneously reducing operational, financial, and regulatory costs. This combination leads to improved profitability and strengthens the long-term financial performance of the company. The relationship between ESG and financial performance has been subject to lots of research. The topic has been focus of numerous individual studies which establish positive relationship between ESG and financial performance. However, I would like to highlight two important meta-analysis studies on this subject. Meta-analysis is a research technique that combines the findings of multiple independent studies to arrive at a unified conclusion. One meta-study conducted in 2015 combined the findings of around 2,200 individual studies to establish academic evidence on ESG factors and financial performance. Following are some of their key findings. This was their headline finding. Approximately 90% of the studies found a non-negative ESG financial performance relationship, of which 47.9% in vote count studies and 62.6% in meta-analysis studies yielded positive findings. Only 8% of the studies showed negative relationship between ESG and financial performance. The authors tried to find if any of the three ESG letters have a dominating effect on the corporate financial performance. They found relatively even positive relationship for E, S and G with financial performance. The highest proportion was found in G with 62.3% of all cases. At a asset class level, more than half of the studies uncovered significant positive performance relationship to ESG criteria. Non-equity asset classes, both for bonds and real estate, display a considerably higher share of positive findings over equities. They then tried to find the impact at a regional level. They found two main patterns. First, developed market excluding North America exhibit a smaller share of positive results. Second, the emerging markets indicate a considerable higher share of positive outcomes as compared to developed markets. In February of 2021, a meta study conducted by the NYU Stern Center for Sustainable Business and Rockefeller Asset Management examined the relationship between ESG factors and financial performance in more than 1,000 research papers from 2015 to 2020. They found a positive relationship between ESG and financial performance for 58% of the corporate studies focused on operational metrics such as ROE, ROA, or stock price, with 13% showing neutral impact, 21% with mixed results, and only 8% showing a negative relationship. They also found positive results when they reviewed 59 climate change or low carbon studies related to financial performance. On the corporate side, 57% arrived at a positive conclusion, 29% found a neutral impact, 9% found a mixed results, and 6% were negative. For investment studies typically focused on risk-adjusted attribute such as alpha or Sharpe ratio on a portfolio of stocks, 59% showed similar or better performance relative to conventional investment approaches, while only 14% found negative results. To conclude, a seminal paper from McKinsey titled 5 Ways That ESG Creates Value states that ESG links to financial performance in 5 important ways: facilitating top-line growth, reducing cost, minimizing regulatory and legal intervention, increasing employee productivity, and last, optimizing investment and capital expenditures.